So there are five financial statements that we'll refer to during this program. The first three are what I'd refer to as the key financial statements. The first one of those being the statement of profit and loss, or an income statement as it's sometimes called. The second is a statement of financial position, and sometimes referred to as the balance sheet. And then the third is the statement of cash flows, which demonstrates our accounts on a cash basis. Now, there are two other financial statements. There is a statement of changes in equity, and there is a statement of other comprehensive income. Now, that last statement, the other comprehensive income, can be consolidated with the statement of profit and loss so that it becomes a statement of profit and loss and other comprehensive income. But for the purpose of this session, we're going to look at those two statements separately. So as we look at the first three financial statements, or our key financial statements, we can break each of those down into three components. So we can remember three financial statements, three components of each. Now, firstly, the profit and loss. Well, that's made up of revenue less expenses equals a profit or loss. Within the balance sheet, we look at our assets, our liabilities, and our assets less our liabilities equals our equity. And then for the statement of cash flows, we're looking at the net change in cash, add our opening cash equals our closing cash. Now, the statement of cash flows is a little bit more in depth as well, as we look at what are the three things that make up that net change in cash. And this is where we can look at that in the structure of operating, investing, and financing. So the statement of profit and loss, or the income statement, those three components plus our revenue less our expenses equals our profit or loss. So revenue are the amounts received by the organisation from selling goods or services to customers. Our expenses are the amounts paid or payable or purchasing goods or paying staff to run the organisation. And then the profit is revenue less expenses, so that the money left over. Of course, if our expenses are greater than our revenue, then that would be a loss. And if you're a not-for-profit organisation, you may talk about this as a surplus or a deficit. The calculation is still exactly the same, but a surplus means we've got more income than expenses, and a deficit means we've got more expenses than income. So as we come to look at the balance sheet or the statement of financial position, we can now introduce what's often referred to as the fundamental accounting equation. So we see this here as the assets equals our liabilities plus equity. Or we may see it as assets minus liabilities equals our equity, just rearrange the equation. But what this is trying to recognize is what are the resources of the business and what are the claims to those resources. So the assets being the resources, liabilities, what money do we owe, what do we owe to organizations, and then the equity, what has been invested in the business. So that would be the residual interest after our assets less our liabilities. So that fundamental accounting equation also leads us into the balance sheet, or our statement of financial position. Now, I often start with the term balance sheet because the balance sheet has to balance our assets minus liabilities equals equity. Or in some cases, we may be referring to as our assets equals liabilities plus equity, as we saw on the previous slide. Now, our assets are the economic resources that are controlled by the organization or by the entity that are expected to benefit the business in the future. Our liabilities is what the business owes to creditors, to other organizations. And then the equity is the owner's residual interest in the organization. So the third of our key financial statements is the statement of cash flows. And as the title suggests, this is presented on a cash basis, not on an accrual accounting basis, as is the income statement or the profit and loss and the balance sheet or statement of financial position. And looking at those cash flows, whilst there are those three components, we want to understand a little bit more about that net change in cash. So we look at that, the change in cash from operating activities, which is our day-to-day activities for the organization, our investing activities, the assets that we might acquire or sell to run the organization, and then our financing activities. So how do we finance our organization, whether that be through debt or through equity? Now, this is a really important statement because it comes to the crux of the matter that if we don't have enough cash to run the organization, then we are running really technically insolvent. If we aren't able to pay our bills when they become due, then that's where we start heading ourselves into administration. So it is really important to understand the cash of the organization. If you're interested in learning a little more about financial statements, have a look at our short course that is listed in the comments below. You'll find within the short course it will take you through an introduction which will walk you through how the program is structured. You will then go through our finance fundamentals, and there'll be a workbook there for you to download, and each section will then be complemented by a little video that will explain the topic involved, and then will be followed up by some activities or a quiz to test and cement your knowledge through those. It continues through the program to talk a little bit more deeply about the profit and loss, the balance sheet and the cash flow statement, and we'll also touch on the statement of equity and other comprehensive income.